Let's get across the market open now. Heath Moss joining us from HLM Investments. Heath, great to see you on
Good
this
morning.
Thursday. Overnight, we saw markets push higher. Nvidia, of course, being the headline. $4 trillion, quite remarkable, isn't it?
Yeah, it is when you consider where we were at the start of the year, and DeepSeek, caused it to sell off quite heavily, and then we had the tariff situation, and it's come ripping back. I think it's all part of that. The AI story is sort of cemented, and the confidence behind it has only grown as the big hyperscalers have come out and you know cemented their plans in their capex spending and have only grown it. I think they're going to be spending over around 300 billion this year in total. Your Microsofts of the world and that building data centers, etc. So, and of course they need those Nvidia GPUs. So obviously the market is growing in confidence there. We should see earnings continue to grow quite strongly for Nvidia. I'm not sure what the street numbers are, but I dare say they're around the 20 to 30% range, I believe. And at this stage, I can't see what it's going to stop at this stage.
So, where does that leave the US equity market at the moment with the focus on the S&P 500?
Yeah, look, I mean, I summed it up in my note as it feels like we're in day three of a test match where the batsmen are really set and comfortable. There's not the pitch isn't really playing many tricks, or neither is the bowler, and anything they're delivering at it, we're able to duck out of the way or play quite easily. And the market's sort of grinding its way up, hitting those ones and twos, the odd boundary, without anything spectacular, and just building a total and. But if you look at the fundamental side of things, the market is starting to look quite expensive again. It's getting to those areas that was before those tariff sell-offs. You're looking at around the 22 times forward earnings here, which is well above the 18 and 20 times, which represent the 10 and 5 year averages you can see in your screen there. So it is looking a little bit expensive. But as we know, markets don't tend to sell off just because they're expensive. They generally have to be, those fundamentals and valuations have to be challenged, like we saw with not COVID, sorry, the sell off with the tariffs earlier this year. So maybe something comes along later this year. I mean, we do have earnings starting, Q2 earnings starting next week with the banks, etc. So if we see commentary from the banks about consumer spending and the way people are spending, if there's a material slowdown there, I like listening to Visa and MasterCard, obviously, because they capture so much of global spending and the US spending, because the US household is so integral to global growth. It's 30% of total US household spending globally. So it is integral to global growth. So I like listening to the real-time comments from these companies like the banks and the Visas and the Mastercards as well as and the retailers. So if something a little bit nasty came out there, I could see that being a reason why we came off again.
All right, and well, I guess to extend your metaphor, what are you seeing locally then? Once again, investors happy to be playing what would appear to be a placid pitch at the moment.
Yeah, again, we've got our earnings coming up in August. I mean, there's not really too many storm clouds on the horizon that cause a little bit of swing, and the pitch really isn't turning or anything. Our market is a little bit more predictable, I think, than the US, given that the banks and the resources, command so much of its weight. Again, they'll be looking to those retailers and seeing the commentary out of there, how household budgets going, house spending going there. We know the household budgets are fairly solid. I mean, people have jobs. We saw the last lot of figures, GDP figures, etc. Whilst they were weak, savings were up. So people were tending to save rather than to spend that in the economy. So it's just about getting that money out into the economy. And we had no favors from the RBA this week. There was a surprise hold there. I mean, if there was a bit of a cut, it would have given the households a little bit more confidence to spend a little bit more money out in the economy. But also, having said that, I think August, as long as those CPI figures, the quarterly CPI figures are in line, August is a definite cut now, and we should get another one or two on top of that towards the end of the year. So that will really help spur the discretionary retailing sector. and also should help the economy overall. So hopefully, because we've had a few lean years when it comes to earnings, I think they've gone backwards for the last 3 years. Hopefully 25, 26 starts to see that turnaround in earnings for the XJO.
Now, Heath, of course, also a focus on Trump's tariff regime, and well, more letters going out, it would seem, but also obviously the focus there on metals, in particular copper. How are you playing this at the moment?
Yeah, look, there was a little bit of a surprise the other night when Trump came out and spoke about the 50% proposed tariffs on copper. I think most people had expected it being around 25%, but we knew there was some sort of tariffs coming, and they were going to be coming before November. Now, obviously, no set date has come in yet, but of course, we saw copper spike, etc. It was up as much as 17% on the night at one stage. That's mainly on the COMEX, the US exchange. Of course, we've seen a lot of inventories move across from the LME to the COMEX to get ahead of tariffs. I think inventories are up about 130% on the COMEX because of that. And the premium on the COMEX is around 25% versus the LME, which is actually a record. So this is quite unprecedented. Now, I would expect once these tariffs are imposed and we have dates, etc., that the COMEX price will settle down again, and maybe we get a little bit of money going the other way again. But really, it is that strong, that long-term structural thesis behind copper is still there, and I think this just showed you this arbitrage showed you how limited stockpiles are, because there was talk of LME participants unable to fill some orders, etc., etc. So. There really isn't the supply out there, and yet our demand is growing. We've got the decarbonisation story that we've had around for some time, and now it's the AI story where we need more power, we need more electrons in our economy and into our system, and copper is a massive part of that. And we're going to need so much more copper to fuel these AI data centers and to electrify or make everything autonomous, basically. So, in Australia, ideally I would have liked some sort of exposure to a miner in the US, but we don't really have that here. BHP Rio do have a joint venture over in Arizona, but that doesn't come online until 2030, 31. But my top pick is you've got it on the screen there, is South 32. They've got their copper mine. It's around 20% of their earnings at the moment. They've got a really nice mix there as well with alumina and manganese when that comes back online. But it's trading really cheaply around here. It's around, I think it's below 10 times forward earnings with a 5% yield. So whilst it's not a pure copper play, I think because valuation and potential upside from those earnings from copper, I think that sits number one for me. The second one would be AIC Mines. A1M is the ticker there. A lot smaller company. I think it's sub $200 million, so much more higher risk than South 32. They've got the Eloise copper mine that they're currently producing. I think it's a tad under 13,000 tons of copper, so very small. They're looking to get the Jericho one going as well, which eventually takes them to about 24,000 tons. So very small scale, but no debt, high free cash flow, will pay, for the expansion of the Eloise mine plus, Jericho moving forward with free cash flow. So I really like them. They're around 30 cents at the moment, 31 cents. The final one is Firefly Metals up in Canada. They've got a very large resource there, brownfields resource. It was mined at one stage, around 1 million tons of contained copper. Steve Parsons, I think, from BGL was part of that group as well. So they've got the management experience behind it from, find to mine, which is I really like. And that one can be a little bit larger. That one could grow from, up to about a 50,000 per ton copper producer in sometime in the future, in a good jurisdiction, great grades, etc. as well. That's one's about $1.10, and I think the ticker's FFM on that one.
All right, we're almost out of time. Heath, very quickly, lithium. I see you're also taking a look down there, and I say down there because that's where it is still at the moment. What are you liking?
Yeah, look, lithium, we've got this maybe a turnaround story there happening. We've seen, I think, in China, prices have improved for the last 11 out of 12 days or something along those lines. But I wouldn't expect a V-shaped recovery. It will be more a U-shaped recovery where prices bounce along the bottom for some time to get through that oversupply, to get through those inventories that these battery companies have accumulated. But I think there is a story there to buy and hold for a couple of years, simply because we don't know where the bottoms are in these things. And the overarching story is we're currently using about 1 million tons of lithium carbonate equivalent per annum at the moment. That is set to grow to 2.5 to 4.6 million tons, depending on who you ask, by 2030, which is not far away, less than 5 years away, and we don't have the supply to do it. So eventually, when we get through this little bit of overhang, the prices should start improving again. So I'm liking Pilbara Minerals, really simple, easy one, producing around 700,000 tons of spodumene at the moment. High cash, $1.1 billion in cash, a further $700 million in debt it can draw upon. It can weather the storm. It's probably losing a little bit of money per ton at the moment, but they'll produce around 1 million tons per annum by about 2029. Really easy one for us Australians to get a hold of, well-known name, etc. Then we have Liontown Resources, obviously made famous because there was a bit of battle there. I think Gina Reinhardt got involved, etc. A little bit more riskier than Pilbara, simply because it's still a startup. They're still ramping up their mine. They eventually want to get to about 500,000 tons by 2027, have $173 million in cash, currently producing around $600 per ton. So not too bad, but again, probably losing money there. But again, these are the types of money, they've got a bit of cash up their sleeve. They've got some inventory. They can withstand, a lower price environment for a little bit longer. And the last one is actually listed on the New York Stock Exchange. It's Sigma Lithium Corp. SGML is their code in the US. Have a Brazilian mine. Only took them like 4 or 5 years to get this mine from find to mine. It was a really quick startup. Very well done, very low cost. Their cost will end up being around $500 a ton in spodumene once they get it fully operational by next year. They're currently producing around 270,000 tons. That goes to about 520 by the end of next year. Just secured a loan from the Brazilian government of around 100 million at a rate of only 2.5%, 31 million cash in the bank. But again, I think most of their offtake, in fact, all of their offtake is unsecured. So it will have the largest leverage to any increase in lithium prices moving forward. Yep. So I like that one as well.